and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, we are going to look a little closer on some really good learning points from the intelligent investor, and afterwards I will give an update to my portfolio as well. So before we dive into the learning points from the intelligent investor, then let me try and motivate why I actually think it is important. Since I had a conversation with one of my viewers who was not feeling too well since we saw this drop in the market over the last couple of weeks. What I'm showing here on the screen is simply just how the S&P 500 has performed over the last month. And very clearly you can see here that we have this drop in the market, and when we go and take a look at my portfolio, you can also see that I have 3 weeks in a row where my portfolio actually dropped in value. So if you view your portfolio with such a short time horizon like a month, then obviously this can lead to major disappointments. And this is the whole key concept of understanding the difference between investing and speculation. Investing is something that you do for the long run. So let me try and illustrate that here. Here you can clearly see the dip when we're looking at a 1 month time period. If we then go to 6 months, yeah, we can still clearly see this dip. What happens if we then go to year to date? We can still see it, but all of a sudden it doesn't really matter that much. If you then go to the full year, which is almost identical, since it's just an additional 14 days, well, we can still see it. If you then expand to 5 years, well, it's still there, but we can see that there has been something going on which has been much more critical. If you recall back to 2020, we saw this drop of 30%, but I mean, even that really severe drop, the worst drop that you have ever seen in a market within such a short time horizon, well, we can still see that over the long run the market is still going up, and it becomes even more eminent when we look at 40-year time horizon. This dip that all of a sudden mattered so much to you, I mean, you can't even see it on the graph. So to quote Benjamin Graham here, the more a stock drops and the more steadily and firmly that you keep buying it, the more money you will make at the end if you are willing to hold it to the end. Of course, this quote only makes sense if the fundamentals of the business is still intact, meaning that you are not seeing an eroding foundation within the company that you are investing your money in. Not all stock price drops are the same. You need to be aware of the fundamentals of the business, because if the fundamentals are eroding, that means that you are potentially throwing good money after bad money. But this quote actually is one of my favorites because it really allows you to view your stock portfolio completely different. I mean, it's like when you own your house, nobody is coming and quoting a price to you on a daily basis or on an hourly basis or on a millisecond basis as you see with stock prices. And a lot of people are tempted to buy and sell much more simply just because they are constantly bombarded with these price changes. If you start to view your stock portfolio the same way as you view the roof over your head, saying you don't really care too much about the price change, the only price change that is interesting for you is when you actually consider to buy or sell. And just because somebody throws a price at you doesn't mean that you have to take any action at all. If we then continue to the next learning point, the reason why I have said that for 99% of all investors or everyone who is following this channel, that simply just buying an index fund would probably be the best investment is actually directly from the intelligent investor as well. Because again, if I allow myself to quote Benjamin Graham from chapter 8, if your investment horizon is long, at least 25 to 30 years, there's only one sensible approach: buy every month automatically and whenever else you can spare some money. And what I actually found quite entertaining when I was reading the book is there is a whole page devoted as a contract that it is meant for psychological reasons, that you can clip that out of the book and sign with your name and date for why you're following this strategy. So every time that you're seeing severe drops in the market, you can bring forth that contract and look at it and say, this is why I'm following this strategy, just as a morale boost. And just to clarify why this strategy is good and why such a contract can be needed, well, the book actually suggests why based on historical evidence. Since, for instance, in 1999, the average contribution to this 401k account, the retirement account that you have in the United States, was around 8.6% of the wealth from your paycheck. But over the coming 3 years, meaning from 1999 and until 2002, that 8.6% has dropped down to around 7, meaning since the market has declined severely over a period of 3 years, then people start to contribute less into their retirement account. So this really shows why signing a contract and understanding why you follow a strategy like this is actually a pretty good idea. If we then continue to the next point from the Intelligent Investor, also from chapter 8, and it is of no coincidence that I have kept the screen on this particular picture, because when Benjamin Graham is asked what keeps most individual investors from succeeding, well, he has a very clear and precise answer. The primary cause of failure is that they pay too much attention to what the stock market is doing currently. And if you have ever wondered what the difference between a speculator and an investor is, well, you can also find the answer to that question in The Intelligent Investor. But here, Benjamin Graham is actually referring back to security analysis, which he wrote all the way back in 1934. Here, the answer to the question is, investors judge the market price by established standards of value, while speculators base their standards of value upon the market price. So how should we interpret this quote? Well, if you again look at the stock price here for the overall S&P 500, well, if you are a speculator and you see a drop like this, then all of a sudden you should start questioning your standards, because after all, your standards is based on the price. While if you are a long-term investor, well, you look to the price and say, has the fundamentals of the business which I'm invested in changed? If they haven't changed, then you evaluate and say, should I use this as an opportunity to buy more, since I can get more for less? But on the other hand, if the fundamentals has completely eroded or has changed, well, then maybe this price change is actually called for. And just before you give me all the criticism about saying, well, you're looking at the 6-month graph, doesn't that mean that you're paying too much attention to the day-to-day movement? You would be absolutely correct. It is much better to look at a longer time horizon if you are truly investing. So don't focus on the day-to-day movement, focus on the fundamentals of the business if you want to have any business in trying to pick individual businesses for your portfolio. Otherwise, do like the 99% of all people should do and just buy an index fund. So after those valuable lessons from the Intelligent Investor and from security analysis, well, let's turn to my portfolio and see what has happened since last time. So as always, the first thing we immediately notice for the portfolio is the color for this week's episode. And we saw that there was a green circle, meaning that the portfolio is up in value. If we then go to the portfolio values tab, then you can see, oh well, there was a green week this week, but last week where you didn't make an episode, there was supposed to be a red circle. I'm sorry for that. Unfortunately, I was ill last Sunday, but just to make it clear here, I'm not trying to hide anything, so you can clearly see that I have had 3 weeks in a row where my portfolio lost value, and now finally I have a week where the portfolio is going up in value again. At the same time, you can see that the cost of the portfolio hasn't changed, meaning that I haven't done any new investments. If we then continue to my favorites tab, namely the dividends tab, let me just zoom out a bit here just to give you the full overview. You can see that November has been finalized, and since I received close to $30 in dividends from Nexstar Media Group, I have actually broken my previous record of $518 since I received a staggering $567 in dividend income for November. I mean, if we actually start to calculate this as an hourly wage and say that you work a little more than 160 hours per month, well, now I'm starting to receive $3.50 every single hour for not working. To me, that actually starts to become something. I know that there's still a long way to go to the minimum wage of $15 in the States, and even before I can live off this, but I mean, $3.50 every single hour for not working, it is clearly going in the right direction. At the same time, you can see here that December is already off to a good start, since I have received a dividend from LTC and from Wells Fargo, so a little more than $30. But keep in mind that the majority of my companies are paying out on a quarterly basis, so that means that I should compare December to September, and as you can see, I am way off the $500 mark there. So the mark to beat for this month is $265. We will see whether or not I come close to that, but more importantly is looking at the quarterly numbers to see that they are increasing quarter over quarter. How the distribution is within a particular month is less important to me. At the same time, over here under the yearly estimated income, you can see that this number has actually increased a little since last time I made a video, and that is without me doing new investments. And that can only mean one thing, that some of the companies, or at least one of the companies which I have invested in, has actually increased the dividends. If we then jump to Seeking Alpha and take a closer look at these happy news, well, we can see that CVS Health has increased the dividend by 10%, namely from 50 cents per share to 55 cents per share. And you need to hold the stock before 20th of January, where you have the ex-dividend day, in order to be eligible for the dividend you would receive 1st of February. And at the price that CVS closed at, it is the equivalent of a forward yield of 2.26%. So if we go back to the portfolio and then scroll all the way to the top here, just so you can see each and every individual holding in the portfolio, it is not too surprising to see that CVS has obviously increased in value within the last couple of weeks after an announcement like that. Then of course you can argue and say, well, are dividends not irrelevant? Well, in the sense that it is actually fundamentals of the business that makes it possible for the company to increase the dividend. But when you see a company increases its dividends and they are not doing that by taking on debt, then of course it is a healthy sign. Just like when you're seeing a company cutting the dividend, you usually see a falling stock price. And just to put the numbers into perspective here, well, I have 70 shares of CVS Health Corp, and since they have increased the dividends by 5 cents per share, that means that I get an additional $3.50 per quarter, or the equivalent of $14 per year. Then there's the withholding tax, then I'm down to $12. So that is why you saw on the dividend sheet that I'm receiving a little more every year, namely $12. So that actually sums it up for yet another exciting week of the Lazy Money Game. So now that you know the difference between an investor and a speculator, and why you shouldn't focus too much on these day-to-day fluctuations in the stock market, well, if you enjoy content like this, then please consider leaving a like or a comment, or consider subscribing to the channel. It really helps me out a lot. And until I see you next time, bye!